On September 15, 2008, a single headline sent a shockwave across the globe. Lehman Brothers, a 158-year-old titan of Wall Street, had filed for bankruptcy. It wasn't just a company failing, it was the world's financial system freezing in real time. The numbers were staggering: over $600 billion in assets gone. It triggered the worst financial crisis since the Great Depression. But this wasn't a sudden event. It was the climax of a story of ambition, risk, and a fatal miscalculation. To understand how one company could break Wall Street, we need to go back to the beginning. The story of Lehman Brothers starts long before the gleaming skyscrapers of New York. It began in 1844 in Montgomery, Alabama, as a humble dry goods store founded by three immigrant brothers, Henry, Emmanuel, and Meyer Lehman. They were cotton brokers trading in the lifeblood of the Southern economy. Over the next century, through world wars and economic booms, Lehman evolved. It moved from cotton to coffee, from commodities to railroads, and finally, to the high-stakes world of investment banking. By the dawn of the 21st century, Lehman was a global powerhouse, a symbol of Wall Street's relentless climb. But inside this success story, a dangerous seed was being planted. The early 2000s were a gold rush, but the gold was in housing. The U.S. housing market was on fire. Everyone believed home prices could only go up. Banks were handing out mortgages like candy, even to people with poor credit and no income verification. These were called subprime mortgages. Wall Street wizards, including those at Lehman Brothers, saw an opportunity. They bought up thousands of these mortgages, bundled them together into complex financial products called mortgage-backed securities, and sold them to investors around the world. On paper, it was brilliant. The risk seemed spread out, and the returns were massive. Lehman went all in. More than any of its rivals, it aggressively dove into the real estate market. Not just packaging mortgages, but also buying commercial properties and real estate developers. Their balance sheets swelled. To fuel this growth, they used incredible amounts of leverage, meaning they were borrowing huge sums of money to make even bigger bets. For every $1 of their own capital, they were borrowing and investing over $30. As long as the housing market kept booming, the profits were astronomical. The firm was reporting record earnings, its stock price was soaring, and its top executives were taking home massive bonuses. They felt invincible. But they were building a palace on a foundation of sand. By 2007, the first cracks appeared. Homeowners started defaulting on their subprime mortgages. The housing market, which everyone assumed would rise forever, began to stall, and then it started to fall. Suddenly, those mortgage-backed securities that were rated as safe as government bonds were revealed to be filled with toxic, worthless debt. Their value plummeted. Lehman Brothers was sitting on tens of billions of dollars worth of assets that were now effectively garbage. The firm that had bet the house on housing was now trapped. The unraveling was terrifyingly fast. The final 72 hours of Lehman Brothers were a desperate, frantic scramble for survival. The weekend began on Friday, September 12, 2008. The firm's CEO, Dick Fuld, nicknamed the Gorilla for his aggressive style, was frantically trying to find a buyer. The U.S. government, led by Treasury Secretary Henry Paulson, convened a crisis meeting with the heads of all the major Wall Street banks at the Federal Reserve Bank of New York. The message was clear. You, the banks, must find a private solution to save Lehman. There would be no public bailout. Throughout that weekend, the lights at Lehman's headquarters in Times Square never went out. Desperate phone calls flew between New York, London, and Tokyo. Two potential saviors emerged: Bank of America and the British bank Barclays. One by one, they walked away. Bank of America chose to buy another struggling firm, Merrill Lynch, in a deal brokered right under Lehman's nose. Then, late on Sunday, the final hope, Barclays, pulled out, citing a refusal by British regulators to approve the deal without a U.S. government guarantee that Paulson refused to give. Inside the Fed, the atmosphere was grim. The banks were all connected in a complex web of trades. If Lehman went down, it wasn't clear who else it would take with it. Each bank was a counterparty to Lehman on countless deals. A Lehman bankruptcy meant those deals would be void, creating a black hole of uncertainty. No one knew who owed what to whom. Trust, the essential lubricant of the financial system, was evaporating. By Sunday evening, the end was inevitable. There was no buyer. There was no bailout. Just before 1 a.m. on Monday, September 15th, Lehman Brothers filed for the largest bankruptcy in U.S. history. The fallout was immediate and catastrophic. When the markets opened on Monday, it was pure panic. The Dow Jones Industrial Average plunged 504 points, its biggest one-day drop since the 9/11 attacks. But the real damage was happening in the plumbing of the financial system. The credit markets froze solid. Banks, terrified of who might fail next, stopped lending to anyone, even to each other. The global economy ground to a halt. A key money market fund broke the buck, meaning its value fell below $1 per share. Something that was supposed to be impossible. It was the equivalent of finding out your bank savings account was no longer safe. This triggered a massive run on money market funds, sucking billions of dollars out of the system. The contagion spread like a virus. The insurance giant egg, which had insured many of Lehman's toxic assets, was brought to the brink of collapse and required a colossal $182 billion government bailout just 2 days later. The crisis was no longer a Wall Street problem. It was a Main Street problem. Businesses couldn't get loans to make payroll. People lost their jobs, their homes, their life savings. The images are seared into our collective memory. Lehman employees walking out of their offices, carrying their belongings in cardboard boxes. The ensuing Great Recession would cost the world trillions of dollars and lead to years of economic hardship for millions of people. So why did the government let Lehman fail, especially after bailing out Bear Stearns just months earlier and AIG just days later? The official line was moral hazard. Bailing out every firm that made reckless bets would only encourage more reckless behavior in the future. They wanted to draw a line in the sand, but many argue that officials simply misjudged the catastrophic domino effect that Lehman's collapse would have. They underestimated how deeply intertwined the firm was with every corner of the global financial system. The decision remains one of the most debated moments in modern economic history. In the aftermath, sweeping new regulations were put in place. The Dodd-Frank Act aimed to make the financial system safer, requiring banks to hold more capital, reducing their ability to make risky bets, and creating new procedures for winding down failing firms in an orderly way. The rules have made the system more resilient, but the fundamental drive for profit and the potential for new, unforeseen risks never go away. So, what would have happened if Lehman had been saved? Perhaps the immediate panic would have been averted, but would the underlying problems of toxic assets and excessive risk have been solved, or just kicked down the road? It's a question we can never truly answer. What we do know is that the day Lehman died was the day Wall Street and the world changed forever. It serves as a permanent, chilling reminder of how quickly wealth can be destroyed and how fragile our complex, interconnected world really is. If you want to understand more pivotal moments in history that still shape our world today, make sure to subscribe. We break down the complex stories so you don't have to. Thanks for watching.